So the rhetoric is bearish. Does the positioning line up with that?
So it's interesting because positioning in stocks has dropped a bit this year from last year, but a lot of that was just driven by performance. So if you look at allocations at the beginning of 2022 and at the end, most of that drop in allocations was just the fact that equities underperformed cash. I think that where we are today is an environment where what's risky is that investors are still hugging a lot of those secular growth, long duration areas of the market. They haven't really shaken this love affair with technology and TMT, and I see that as the risk within the equity market. That area of the market is still relatively crowded. Surprisingly, energy, even though it's had, a stellar couple of years of performance, is still a pretty significant underweight in the average mutual fund. So I still think there's a lot of alpha to be made in sectors, but we have seen allocations in overall equities come down. The problem for me, though, is that everybody's talking about this recession. We've got the most telegraphed recession in the history of mankind coming up, and the problem is everybody is kind of using muscle memory to go back into what they think of as the safest equity market, which is the S&P 500. Trouble is, if everybody is in the S&P 500 and they're all selling at the same time, the S&P isn't really that safe. So our view is that within the equity portfolio, the S&P 500 is actually the most crowded ticker in the world, and it's time to go into other benchmarks like small caps. And we've talked on your show quite a bit about small caps, my colleague Joe Hall and I. And, I think that's really an area where you can get exposure to equities without the risk of, everybody being crowded into the same index fund.